Tim, welcome. It's good to have you here. We all know your equipment. We wear your equipment, as a matter of fact, I think many of us. So give us your perspective overall on the retail environment right now in the United States.
Well, I think in the United States, business is pretty good. The consumer's pretty healthy. And, you know, for our business, when it's snowing in New York City, everything looks good.
So specifically Columbia, where do you see the greatest growth opportunity for you?
Well, I think for us, you know, we have a big business in outerwear and winter footwear. That's been what we've been known for. But we've made a strategic focus in the business to expand our product lines into more sportswear type products that can be used when it's not wintertime. And that's been a very successful part of our business. I spent last week in South America working with our distributors down there. I think the consumer is fairly healthy globally based on what we see. And, you know, our business has been quite good. And you know, the important thing that we all talk about is making sure that we don't have further tariff impact on the business. Yeah. So apparel and footwear are already one of the most heavily tariffed products of any kind of commodity, and additional tariffs would be problematic for sure.
So how are you mitigating that? What's your margin outlook for next year?
Well, we don't know what's going to happen with the tariffs, and frankly, with 40% of our business being outside the U.S., there's little likelihood that there'll be any tariffs on that component of the business. And frankly, we have a very broad, diverse sourcing base across the world. So China represents around 10% of our total product imported into the U.S. But, you know, it's just the uncertainty of what might happen with some tariff implications.
And that's sort of the one side. What about unit labor costs? What do they look like for you?
Well, labor is one of the fastest growing components of our costs, really globally, but it's one of the smallest percentages of our total cost of goods. So we want to make sure that we have really motivated employees in the factories where we're working. So we make sure that we have really high quality benefits, et cetera, for the factory workers that work in our subcontract factories. And then domestically, we've seen some significant price increases as it relates to labor, especially in our distribution centers.
Staying for a moment on the subject of costs, Tim, what about freight? What about shipping? Do you see that cost rising as well? We see that with other retailers.
Yes, absolutely. You know, logistics, the entire cost of getting the product from the factory floor to the floor of the retail store, it requires tremendous coordination. And so our efforts have been around coordinating what we can do to make the business more smoother and run more efficiently. But freight costs, especially as it relates to fuel costs, have been out of control.
So take the flip side of that. What about pricing power? People are making more money, more people are employed. Do you find more ability to increase prices to pass along at least some of those costs?
You know, I think this is a brand by brand deal. So we've made very focused efforts on increasing our demand creation costs and expenses in that area, because we want to make sure that when consumers are looking around, we have the pricing power to compete against other brands that they're looking at for a particular commodity.
So how do you balance the pressure that you're seeing, say, from labor and also needing to be competitive on price? Are you eating that difference?
Well, we try to run a very efficient operation. We've been in business for 80 years, and we have an enormously strong balance sheet. We just spent the last 18 months on a project we call Connect, which is to take out some of the superfluous costs in the business and make ourselves more efficient, to drive more funding for demand creation. So for us, it's about, you know, starting with the product, because at the end of the day, consumers are buying actual products, and then making sure that the brand carries its promise all the way through. So this is a sort of a typical consumer products exercise. We just have to put the equation together and make sure that we've got the right variables impacted.
At the same time, as we mentioned, sort of next year, potential more headwinds, the labor market's going to keep getting tighter. We don't know what's going to happen with trade. So how many more levers, how much more efficient can you get to offset some of those potential issues?
Well, I mean, there are a number of levers we can pull, including, you know, how much we spend on various products and projects. But it's really about a holistic view of how we bring our products from the minds of our designers all the way through to the floor of the store and how it looks when it's at the store. So this is not as simple as, you know, make it cheaper. This is about making the products more compelling and giving yourself pricing power.
So, Tim, you said how it looks in the store, which raises the question of e-commerce. When we talk about retail these days, we have to talk about people buying things online. How are you playing that? How do you take advantage of that? How do you make sure you don't lose a competitive advantage?
Well, about 10% of our products are sold through our own e-com businesses globally. And, you know, those things, the look and feel of an e-commerce site are just as important as the way products are displayed in a physical retail store. And then most of our large retail customers, people like Dick's, REI, Amazon, know how to handle and manage the various components of data that make it more efficient to run these businesses. And frankly, we don't see the e-com business, the digital business, growing to much more than about 15, 20, 25% of total retail sales of our commodities.